The rising market has rekindled the debate over what's the best way to invest. Use a low-cost index fund that basically matches the market, or try to beat it over time by hiring an active fund manager. Well, it appears the people have spoken. In all but one of the past 7 years, reports the Wall Street Journal, net flows into index or passively managed stock and bond funds have far outpaced those into actively managed funds. This year, through July, according to Morningstar, investors dumped $177 billion net into index funds. Into actively managed funds, just $78 billion. Here to tell us whether those investors are making the right choice is John Hale, Director of North American Research for Morningstar. John, welcome. Good to have you with us. So are they making the right choice?
Well, I think for many investors out there, passive investing is certainly a very good choice. You get low fees, you get returns that are, as you say, are going to generally match those of the market. You know what's in the fund, in an S&P index fund. It's great. It's the kind of thing where investors today are looking at the headline of your show and seeing what the S&P 500 is doing. They're going to say, you know what, I feel confident. I know what I'm getting in my portfolio because that's the kind of fund I'm invested in. So there's a lot of good things about it.
John, when you compare the performance of whether it's actively managed or if it's an index fund, how do they rank? I mean, how often do the actively managed funds actually beat out the passive funds?
Yeah, well, it's interesting. I think the problems with active investment performance have been a bit exaggerated, but it's absolutely true that on average, actively managed funds tend to trail passively managed funds, no matter sort of what way you slice it, whether you're looking at, large cap U.S. stocks or in most cases some other areas of the market that have, index options. But kind of the other side of that is that the average actively managed fund doesn't necessarily trail by all that much. And in any given sort of period of time, like we were looking at the 10-year trailing period just earlier today, in the U.S. large cap blend category, the average manager trails by just a few basis points over that 10 years on an annualized basis. And, there are about 30% of the overall universe that's outperformed indexes. So it's definitely possible to find active managers out there. It's also the case that maybe it's not so much... Go ahead. Yeah.
I wonder, because you just said something very interesting. 30%, did I hear you right? Only 30% or roughly 30% of active managers beat the benchmark over time?
Over the last 10 years, yes, as of July, correct.
So I'd have a 70% chance of doing better in something that wasn't actively managed. Do active managers do better in down markets, or do they do better, for example, in more esoteric markets like emerging markets or alternatives?
Well, I think definitely better in esoteric markets like emerging or alternatives. I mean, in alternatives right now, you can't really index alternatives, so any of your passive investing options there are sort of rules-based quantitative strategies that really don't have anyone at the helm other than the people just executing it. So you're better off with active managers there. Emerging markets, there are areas of emerging markets where maybe you don't want to be in at the moment, and an active manager is going to take you out of that, whereas an index isn't going to be able to.
All right, John, thank you very much. John Hale of Morningstar tonight.